A new report from Rosenberg Research says that the Canadian economy is on life support and that the economy probably shrank in 2 of the past 3 quarters. And we are on a clear recession watch for 2026. Let's get more from David Rosenberg, founder and president of Rosenberg Research. David, thanks very much indeed for joining us.
Great being with you, Andy.
The Bank of Canada has brought down interest rates by almost 3 full percentage points since 2024, but you reckon more is needed?
Well, the proof of the pudding is always in the eating. So, the bank has cut the policy rate by 275 basis points. Of course, the only people that borrow at the overnight rate are the banks. And nobody borrows at that rate, and other interest rates haven't fallen nearly as much. When I see the proof of the pudding's in the eating, question is, since the Bank of Canada started cutting interest rates in the spring of 2024, what's the Canadian economy done over this time span? And it's barely better than a 1% annualized growth performance. And although the population trends have slowed with the immigration rule changes, real per capita GDP in Canada is still declining. That has not been arrested. I would completely agree that the Bank of Canada probably never should have gone to 5% to begin with. So we came off rates that were very elevated. But it's clear to me, unless the policy lags are just a lot longer this time around, that if this is what 275 basis points of Bank of Canada rate cuts delivers, the grand total of a 1% growth economy, the next question is that all you get?
This kind of reminds me of the interest rate policy in the wake of the 2007, 2008 banking crisis. Low interest rates didn't seem to stimulate growth then at all. Well,
it's, Tiff Macklem wasn't wrong that a lot of the, call it structural issues with the economy are developments that transcend the power of the central bank. But at the same time, if I were in Ottawa and I were in his shoes, I would be doing all I possibly can. Inflation in this country is not really an issue. Virtually every underlying inflation measure is comfortably within the Bank of Canada's comfort zone. And the economy is growing below potential. And the Bank of Canada's own forecast, when you dig through the details, is for this disinflationary output gap to be with us, not just this year, but through the end of 2027. So I'm a little surprised that the Bank of Canada is taking such a strident approach. I do think that they will be compelled to cut rates further, even from this egregiously low interest rate. And I think the Canadian dollar, which I had been bullish on tactically, is going to come under some renewed downward pressure at the same time, because there's a case to be made that the Fed probably doesn't do anything at all, at least through the first half of the year.
We have a chart from you guys just showing real GDP year-over-year percent change going back to 2022, and it shows a relentless decline.
Yeah, we're running
in growth, I should say. Sorry, go on. Sorry, David. Yes, go ahead.
Oh yeah, we got the monthly data late last week. The GDP trend is running at roughly 1%. The fourth quarter sequentially, as you mentioned in your preliminary remarks, is probably going to be fractionally negative. And I'm trying to look around for, what the source of vitality is going to be. I'm really quite surprised that most base rate economists have an inflation view, or at least some of them do, and that everything's going to be fine and dandy because we're going to get a modest amount of fiscal stimulus. I think this is still very largely a show-me situation. I'm looking at just a broad array of indicators, and it's quite striking. You would think that of all the sectors that would benefit from what the Bank of Canada's done, you think would be the housing sector. But if you look over the past year, residential construction expenditures are flat as a beaver tail. Home prices, everybody was telling me back in the summer of 2024, when the Bank of Canada started to cut interest rates, people were saying to me, "Oh, just wait, they're going to reignite renewed rounds of housing inflation." None of that has happened. In fact, home prices in Canada nationwide have either been flat or negative sequentially for 10 months in a row, and are running negative 2% year over year. And then, we were hoping up until recently that there was some sort of detente with Donald Trump, that his relations with Mark Carney were starting to improve. Well, of course, we can throw that in the waste paper basket right now. But, you're taking a look at manufacturing activity in Canada, even with what would be deemed a competitive exchange rate and red hot U.S. economic growth that you'd think would be pulling in Canadian shipments. Manufacturing is actually down 5% year over year. Like, you're talking about a recession. Well, you have a recession already in the manufacturing sector. And there's no real thrust in terms of retail sales. When you adjust for whatever inflation there is at the retail level, there's practically no growth there either. And that, of course, is very interest sensitive. So it comes back down to, your view on the Canadian dollar is basically if manufacturing and exports, it's incredible. Exports are lower today, the level of exports, than they were in the spring of 2022. And they're also running negative year on year. Manufacturing, I mentioned, and industrial production running negative year on year. That's telling you that as weak as the Canadian dollar has been up until recently, it's probably not weak enough. You want to be bullish on the Canadian dollar, you have to start seeing real positive thrust in the areas of the economy that are most sensitive to the currency. It's just not happening. And that's a huge disappointment, especially to me, because I changed my call to a more bullish view on the loonie late last year. But the only reason why the Canadian dollar is off its lows, of course, it's retraced part of that, is only because of the broad-based debasement trade in the U.S. dollar. I'll tell you what Canadians should be measuring the Canadian dollar against is really against the Australian dollar and the New Zealand dollar. And it's not because we do a lot of trade with those countries, but those are our, commodity-oriented brethren. And the Canadian dollar, just in the past 2 months, is down more than 4% against both those currencies. What's that telling you? Well, it's telling you that they have higher interest rates because they have stronger internal demand. Of course, they're more hitched to Asia than they are to the United States, so they're hit less by all the trade uncertainty. And that's just the currency aspect. If you believe that the Bank of Canada should keep rates on hold, if you believe that interest rates are actually working, then you have to ask yourself the question, why are the most credit-sensitive sectors, primarily housing, residential construction, home prices, retail trade, why are they all basically either stagnating or declining? And that's telling me that as much as the BOC has done, they haven't done enough just yet.
David, before we let you go, we're tight for time. What about Ontario? Because it's kind of emerging as the sick man of Canada in economic terms. The Fraser Institute said in August, a while ago, that economic stagnation in this province means that we now, in Ontario, have a lower standard of living than the rest of Canada. Is that a big part of Canada's malaise, Ontario going nowhere?
Well, look, Ontario's the poster child for the deterioration in trade relations with the United States. There's no other province that has that sensitivity to manufacturing, which I said is in recession. And there's no other province that has such close economic ties with the United States. So that's really the big problem for the Ontario economy. We're not resource oriented. There's been obviously a bull market in most resource prices. Well, that's not what Ontario is about. Ontario is a manufacturing hub with tremendous export sensitivities to the United States, and that's why the province has been penalized.
We'd better jump, David, but your message to Tiff Macklem, start cutting again, or think about it strongly. David, thank you very much indeed for joining us. David Rosenberg,
Thank you, Andy.
founder and president of Rosenberg Research.